Dividend growth investors, bonjour, Mike here. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And today we have the most famous quarterly banks earnings report. So every quarter I do a full review of the big six, so all the big Canadian banks, and I'm starting to integrate as well EQ Bank, and this quarter I'm going to introduce you to GoEasy on top of that. We're going to go through the big six. We're gonna talk a little bit about EQ Bank and GoEasy, and at the end of this video I'm going to explain you how provision for credit losses works, because today we're going to talk a lot about PCL, so provision for credit losses. So there you go. Let's get started with the year-to-date total return, just to see a little bit how all the banks have done. So as you can see, EQ Bank is flying on top since the beginning of the year. We have a strong number 2 with my favorite bank, National Bank. And then you get like pretty much like some positive, some negative. It's kind of like a little bit blurry here. We're gonna dig into the numbers to see what's going on with all the big five. One thing that I added to this graph for this quarter is the XIU. So just want to compare it to the TSX 60. TSX 60 total return of 4%. So you can see that half of the banks beat the TSX 60, the other half underperformed. And another very interesting fact, I added the BMO covered call ETF. So they're writing covered calls on the big six banks. And interestingly enough, this one, the total return, so that is the price that you pay plus the dividend, and then yet you're losing money, minus 0.73. So while you'll be thinking I'm generating more income, well, if you had a basket of all the banks, you might have done a little bit better, and definitely it's not able to beat the market. So before we dig into the results, let's talk about the most important part. Is the dividend safe? Was there any dividend increases? And man, there was a lot. Actually, as you can see on this chart, all banks offered a dividend increase but TD. But don't panic, that's normal. I put it in red here just to make you freak a little bit, but TD increases its dividend once a year, while all the others are going with 2 entries, so in the second quarter and the fourth quarter. I was pleasantly surprised to see another raise from Scotiabank, because Scotia kind of forgot last year in Q2 to increase its dividend. So last year, for the full 12 months, we had only 3% dividend increase. So it's good news that they're trying to send a message. They're maybe going back to that biannual dividend increase with 2.9. As you can see, it was really like 2 to 3% increase for everybody, but National Bank with a 5% increase. So over the past 12 months, we're talking about 10% increase for National Bank. In terms of earnings, what you can see here is most of them are down, minus 4, minus 6, minus 9. You have Royal Bank and Scotiabank minus 11 and 22%, but most of the time it doesn't mean that much from one quarter to another. Sometimes just like higher provision for credit losses, or it's a one-time deal, so you don't have to worry too much about this part. But still, as you can see, it was not a good quarter for banks. We're gonna see that in a moment why. In terms of percentage, well, National Bank is the lowest one, but when you think about high, like most generous dividend grower, the lowest payout ratio among the big six, kind of sounds like a good deal. All the others are close to 5%, and then you have the classic laggard, CIBC and Scotiabank, with higher payout ratio and higher yield. The thing is, you're going to discover that later on today in this video. They also show a lower PE ratio on average, but the problem is we're more concerned about them, and they show less growth perspective. So those two things are playing out on the yield, and they're playing out on the payout ratio. You can see that those banks are making a little bit less money, and they're being more generous with their dividend yield, but I don't see them as growing companies going forward until they can solve their problems. So let's get on with the results per segment for each of the bank. As you can see, it goes up, it goes down, it goes all over the place. So it's kind of like a little bit difficult to understand what's really going on. So let's get started with the main theme. All banks made higher revenue because interest rates are increasing. Most of them showed better net interest rate margin, meaning that they're making more money on their loans. obviously because interest rates are higher. So higher revenue, everything looks good on that part. Unfortunately, what offsets most of those results are two things. The first one is provision for credit losses. So every time they look at their loan portfolio and they're like, yeah, I think those are going to be late, they put them in their provision for credit losses. So they kind of like put money aside for them. But when they do that, it hurts their net income. It hurts their earnings per share as well. So this is why we kind of had a pretty slow quarter for all the banks. It was not good news in general because banks are telling us, you know what? Economy slowing down. We can see that some of our customers are having problems paying down their loans, and we need to take higher provision for credit losses. So it obviously not a good sign for what's coming up going forward. The other reason why they have been hurt, well, it's pretty much inflation. So higher expenses pretty much everywhere, and several banks have mentioned that they have like higher employees compensation or benefits cost. So it is costly to retain talent to make sure that they continue to grow. Among the highlights that you can see this quarter, BMO had a higher provision for credit losses, mostly because of their acquisition of Bank of the West. You're all aware of the bank saga in the US. So all regional banks, some of them are struggling right now with their deposits versus the bonds value. So the thing is, whenever the client wants to withdraw their deposits, they're backed by long-term bonds, and long-term bonds, they lost a lot of value because higher interest rates over the past 18 months. And this situation not about to end, so you have to be very careful. For National Bank, the biggest problem here was in the US and international market. It's been like 2 or 3 times now that we see that down double digit, higher expenses, higher credit provision for credit losses. So while it was like a darling segment for them not too long ago, now we can see the weakness and the volatility, kind of like similar to Scotiabank with their international market, but fortunately it's still a small segment for National Bank. For the rest, strong performance in personal and commercial banking, strong performance in wealth management, but capital market got hurt, higher expenses and higher PCL. For TD, they announced no more deal for First Horizon. So while BMO was already acquired Bank of the West when the banking saga happened in the US, TD was in the process of acquiring First Horizon. I think it was like $13 billion, something like that. It was like kind of like a big chunk. And they said, you know what, we're going to pay the fee. We're going to cancel the trip. We're not going to go there. I think it's a good decision right now. They already have a strong exposure to the US market. Roughly like a third of their business is happening south of the border. And right now with all this uncertainty, I think it's a good thing to just lay low and make sure they consolidate their stuff and they are strong. For Royal Bank, was not really a good quarter. Not much to say about this one. I mean, capital market was up, which compensated a little bit, but the personal and commercial bank, wealth management, the US exposure, nothing that went well there. For CIBC, they've been hurt big time with their exposure to the US market. So again, it could play in your favor, but it could also be a problem, a burden. Well, this time it is definitely a burden for CIBC, but I was surprised with their strong performance in personal and commercial banking in Canada. Actually, the provision for credit losses there was not that high, which explained why they performed so well. And Scotiabank got saved by international market, mostly because of currency exchange and a good performance. However, as it was the case for all the other banks, wealth management, capital market, personal and commercial banking in Canada was not going that well either. Now moving on, so on a small commentary on EQ Bank and GoEasy. They are smaller, they are really focused on classic savings and loan stuff, so they're not as diversified, but they show very interesting growth potential. So EQ Bank, earnings per share up 2%, which is completely the opposite for all the other big banks, mostly driven by a lot more customers, so they're up 26%. Very strong lending growth as well, both on the personal and on the commercial side. They also increased their dividend by another 6%, following up a dividend increase of 6% last quarter. So it's 12 over the past 2 quarters, which is way ahead than all the other banks. And one thing that explained that is they're making a bunch of loans. They're not losing that much on it, and they have a very, very small provision for credit losses. We're talking about $6.2 million this quarter, which is almost nothing. If you compare to National Bank, for example, that went from 3 million in last year up to 85 this year, and definitely National Bank is a lot larger than EQ Bank, so just giving you a perspective here. GoEasy had a very good quarter. Again, there's a lot of concern about those like alternative credit lender, where they, like GoEasy, most of the time they will lend money to people that have not many other choices but to go see them. And actually they got hurt big time because there were some laws change in Canada where the limit of interest rate has been decreased, the maximum interest rates you can charge on a loan. They already had that limit in Quebec, but not outside of Quebec. So for the rest of Canada, they were just charging a little bit more, making more profit. Now it means that the new loans, they have to be less profitable. Still, they're still able to charge in the 30% interest rate per year. So, I mean, I don't think they're gonna die, right? Record quarter for revenue, $249 million. Earnings per share up 14%. And the net charge-off rate is in line with what management expects within this business model. So it was at 8.9%. So you're thinking like, almost like one loan out of 10 is not being paid, but they expect between 8 and 10. So they're right in the middle of their guidance. So it means that they price accordingly, they make their money, and they have a strong underwriting process. As long as they hit that target between 8 and 10% of charge off on their loans, they're gonna be profitable and they're gonna make money. So kind of like an interesting business model here. Be very careful, highly volatile, and if the economy deteriorates faster than we expect, this is the type of business that could go belly up very fast. Now a quick look on the PE ratio, and after that we're going to move on to the forward PE ratio. As you can see right now, the best deal on the market seems to be EQ Bank, Scotiabank, and TD Bank. Interestingly, EQ Bank, smaller player, so obviously they're going to get less market love from institutional investors and others than the big banks. So that explains a little bit why it flies under the radar. For Scotiabank, as I told you before, they're slowing down a little bit everywhere. There's a lot of concern about their exposure to international market, especially with higher interest rates and a global economic slowdown. Do you really think emerging markets are going to thrive in this kind of situation? I'm pretty sure it's going to be the opposite. So I'm not too sure how Scotiabank will outperform the other banks going forward. For the TD Bank, big exposure to the US, a lot of concern around banking there for regional banks. So this is one of the reasons. I think it makes it one of the most interesting banks right now to go in. Again, it's not a financial advice. You have to do your due diligence, but I'm just telling you right now, like the last time I had to put $1 in a bank stock, it was on TD. So you do you, I do me, and then we're all good. When we look at the PE forward ratio, we have the same situation where EQ Bank is expected to continue to thrive, so trading at 6 times future earnings, which is kind of crazy, right? You got after that CIBC and BMO trading around like 9 times the earnings, along with Scotiabank, TD Bank, and National Bank, Royal Bank are at 10 times the earnings. You got to be careful here. Obviously, it's going to be a bit more expensive, but they show stronger numbers, so there's a price to pay for quality. Definitely, National Bank doesn't look like a good deal right now. I would definitely take a second look at TD instead at this point. But I'm going with National Bank. It's one of my largest holdings, and it's going to stay that way. I'm pretty sure you get to know why now. So we're going to end up this video explaining a little bit the mechanic behind provision for credit losses. I call it the PCL magic. So on this graph, I've put only the big 5 just because I didn't want to put too many lines on the same graph. And I wanted to show you the impact on provision for credit losses on earnings. So what you see here is what happened between January of 2020 all the way down to the end of 2021. So just to see how provision for credit losses were handled during the biggest part of the pandemic, where everybody started to freak out. So you can see that in May of 2020, all earnings went down because all banks, they were just saying, you know what, we don't know what's going to happen, and then we had all eyes to know what was going on with their loan portfolio, their exposure to like hotels or the energy sector and all the recreational and entertainment, because everything was closed. So that was like the big talk. We saw higher provision for credit losses, but in the end, what happened after that is once they reviewed because they have to review their book every quarter, and they review their book and they just say, you know what? At first, we thought they would not pay off and we had to like charge off those loans. But in the end, we realized that no, most of those people those businesses are paying back their loan as usual because they got pretty much safe, let's put it that way, by the government. So long story short, fast forward in 2021, they reviewed their book. They realized that payments are being made. And then what they do is that they create a recovery. So they took like earnings, net income, put it back into like some kind of like a security in the PCL. And now they're revising the book and say, you know what, we're going to make a recovery. So they're taking the PCL and putting it back into net interest income and their earnings. And this is how earnings go back up quickly. Now, it doesn't mean it's always going to be this way. So what I mean by that is right now banks are increasing their provision for credit losses, but sometimes they do it for the right reason, because some people will not be able to pay their mortgage because interest rates are higher. Some businesses are going to close and they're going to leave that loan to the bank and say kiss it goodbye. So it is possible that those provision for credit losses hurt their earnings and it's not going to be recovered. So you have to be careful and not always think, oh yeah, PCL is going to drop the earnings this year. This means that in 24 it's going to be an amazing year for bank. It may not be the case. Historically, banks tend to be very conservative. So it is a good sign most of the time where you can expect higher earnings per share the following year after a bad year in terms of provision for credit losses. But it's not always the case. So you have to tread carefully. You have to make sure that you review the business model, you review the loan portfolio, you review the dividend triangle, making sure that the revenue, like you'll see, all earnings for all banks are now like they at the plateau and now they're all going down. It's normal, but then you have to follow the trend. Make sure that they're well capitalized, make sure that the payout ratio is in line, and make sure that the dividend growth continues its straight line. I was concerned about Scotiabank last year at the end of the year because they only increased their dividend by 3% for the entire year. I was happily surprised to see another increase in Q2. Hopefully they're going to follow up in Q4 with the classic B annual dividend increase. But if it's not the case, then it's another red flag added to the same stock. At one point, you have to be careful and do your due diligence. All right, so if you have any questions about banks, I'll see you in the comment. I'll be more than happy to help you out. If not, give me a thumbs up. Follow this channel. Every Thursday, we publish a new video. And until the next Thursday, don't forget to stay invested.